Hey, happy Friday. This is Tracie Schmidt, mortgage loan officer, and I wanted to share with you a quick buy down calculator. So I've been talking a lot about the 3-2-1 buy down, the 2-1 buy down, and then what it would look like if the seller gave a credit and the client used that credit to buy down the interest rate for the life of the loan. So I want to show a quick comparison, whether you're a potential home buyer, whether you're a real estate agent. I just thought it was really important to kind of share what those differences look like. So I'm going to take a second and I'm going to share my screen here. So this way you can see how I would go ahead and kind of work up that information. So if you look here, I did a sales price of $775 and a loan amount of $700,000. That's 10% down. Now, the reason why the down payment is important is because depending on the down payment and the loan program, the seller concession or the credit you can get from a seller varies. So if someone's buying a property owner occupied, meaning you're going to live in it, and you put at least 10% down payment, you can get up to a 6% credit from the seller to go towards one of these particular buy down programs. So, and again, as the buyer, this doesn't cost you anything extra. It's just a way for you to set up the loan. So this way you could take advantage of lower interest rates at the beginning of the mortgage loan period. So current market rate around 7.375 right now, 7.5. You could see it's going to calculate your monthly principal and interest payment. That's going to be calculated on the 7.5% interest rate. Then you have your property taxes, your homeowner's insurance, any mortgage insurance that you're going to have. And in California, the tax rate is definitely higher than other states. We are licensed as a region in 38 states. So we would run this example based on what the tax rate is in your specific state as well. So you could see here. So first we have the 3-2-1 buy down program. So the cool thing about this program now is that in year one, your interest rate is 3% lower than market that you locked in at market as of today, let's say. Year two, it's 2% lower, and year three, it's 1% lower. So you could see that you're right here getting a lower interest rate than what you locked in at. Here's going to be the new principal and interest payment. Okay, this is only principal and interest. It's going to calculate the monthly savings and then the annual savings. And the reason that's important is because it takes all of those numbers and adds it together. And it tells you this number here, which is what you would need from the seller of the home as a concession to go towards this particular product. Now, like I was telling you, if you put 10% down, you can actually get up to 6% in a credit. In this example, we're at 4.239%. So you may even have some room to be able to go to the seller and ask for additional credits to go towards other closing costs. So in this particular example, this would work. You could see what the total monthly payments would be in the different years. Now, this is including the property taxes and insurance, right? And so all I did is I took here the new buy down payment, I added the taxes and insurance and mortgage insurance, and it comes up with a new total monthly payment. So you can really see how this impacts a potential buyer. Now, the goal is that interest rates go down, right, over the next few years. So if they go down, let's say in the next 2 years, right, and it's better than what your current market rate is, then that's actually going to allow the client, if they wanted to refinance before this buy down period ends. Now, people are asking me, well, what happens with that money that we put into that account at the beginning from the seller? Well, if the client refinances before the buy down period is up, that additional money from that account actually goes towards paying down their principal balance. So it is really benefiting the seller in all aspects. Now you're asking, I'm sorry, it's benefiting the buyer. Now you're probably asking, like, why would a seller do this? So number one, it could attract more buyers if your listing has been sitting a little bit. Number two, sometimes the sellers will look to bring down the price of the home they're selling. Instead of doing that, they can basically offer an incentive for that same amount. And that's actually going to be able to benefit a buyer, right? To bring more people in to sell their home faster. So it's a great tool. You could see here, there's the 2-1 buy down. The only thing different about this is it does not have year three factored in. It only has the lower interest rate for 2 years. And then you could see here that the seller concession needed would only be 2.152%. So let's just look really quickly in a second. Now, if you only put 5% down, right, you can have up to a 3% seller credit. So this example will work. So I'll show you those numbers in just a second and how we can work that up. The third option is, let's say you don't do a buy down program, but you can get up to a 3% total credit from the seller. and the client wants a lower interest rate for the entire life of the loan. They don't want to take any chances of, getting into that year 4 or that year 3 or trying to refinance. So in this example, they could actually get a 3% credit from the seller. It would buy down their interest rate to 6.75. So about 0.75% down from current market. And then you could see the monthly savings, what that would be versus not getting a credit from the seller. Okay. Now they could also themselves buy the rate down. So it's going to work a little bit differently because of high cost limits in different states. But you could see here, again, it lowers the client's monthly payment, and gives them savings by using a credit from the seller. Okay. So let me just show you really quick. If we take an example and we do only 5% down, so you could kind of see how those numbers change. So if I take 775 times 95%, that's going to give us a loan amount of 736,250. Now you have to be careful depending on the county that you live in, because this is a non-jumbo product. So we have to make sure that the loan amount that you see here is the loan amount that's allowed in your specific county. So that's something that you'd want to look up, loan limits in whatever your county is. So you could see as I change that, it's going to automatically change our payments, how much we would need, what the concessions would be from the seller, monthly savings. So it changes our principal and interest payment, right? It's going to go higher because you're financing more money. It'll change our monthly mortgage insurance. So I'm going to bump this up. Of course, I would run specific numbers, right? But let me bump that up as well. So you could see as I make these changes, it's changing this automatically. So I don't want to go into, a lot of information to confuse you, but I just wanted to show you the tools that my team has in order to help a buyer or a seller or a real estate agent quickly understand what these products look like. So reach out if you have any client scenarios that you want me to work through with you, any buyers that you want me to contact that have maybe been sitting on the fence, or any sellers maybe that you're working with that can't move their property, that we can present this to them, and maybe I could look to be a preferred lender that you work with any buyers coming through the home. So I look forward to talking to you. If you are a home buyer and you're interested in getting more information, there's no obligation, nothing to do, just a consultation with me to see if you can actually get into a home now, even though market rates are a lot higher than where they've been. You can see in this particular instance, you can get down to 4.5%, which is amazing. So I hope to talk to you soon. You can call or text me at 858-336-5200. I would love for you to maybe, like this post or comment. Feel free to, click the link and get in touch with me, and I'll talk to you soon. Bye.